You're going out and you're buying property for the purpose of the example, let's say a single family house, but you're not buying it to live in, you're buying it to rent out to another family. That way they pay you rent. And if you do it correctly, that rent is going to pay for your property taxes, your insurance, your maintenance, your management fees, and your vacancy, and put some money in your pocket every single month. Now, there's a few things you have to understand about real estate investing. The first thing is why real estate investing is so powerful. And this is me telling you as somebody who's been investing in real estate for more than a decade and as a licensed attorney. The reason why wealthy people love investing in real estate is because number one, you can create steady cash flow because as you work to acquire more properties, each property, if you do it right, will put more money into your pocket every single month. Number two is you own a hard asset. When I own a property, I own the bricks. I own the land, I own the windows, I own something that I can see, feel, and touch, versus with the stock, I just get a piece of paper saying that I own something, but I don't actually have a real asset. And number three is you get tax breaks. As a licensed attorney, who is not your attorney, what I can tell you is that real estate has some of the biggest and best tax breaks that a tax code has to offer. If you make $1 million a year as a doctor, you're probably going to pay half of that, or around $500,000 in taxes, depending on what state that you live in. When you make $1 million a year as a real estate investor, you could potentially pay $0 in taxes because of the depreciation deduction, because of accelerated depreciation, because of something called ordinary and necessary. I'll explain what all this means in just a second, but essentially you have the ability to make more money and pay a whole lot less money in taxes legally. Let me show you how it works. Let's assume you find this 3-bedroom, 2-bath property on sale for $200,000. Now, if you're saying, well, Jaspreet, where in the world am I going to find a property like that for $200,000? Well, maybe you got to look in a different market, because in Metro Detroit, you can find these types of properties all day and night long. You buy this property for $200,000, and let's assume that you can rent this property out for $2,000 a month. Now, here's the key. You're buying this property not to live in yourself. You're buying this as an investment to rent out to somebody else. That's the main difference, because when you buy a property for yourself, money is constantly coming out of your pocket. When you buy this as an investment, you're buying this to create a new income stream. So now, here's where the magic happens. You rent it out for $2,000 a month, but you have expenses. You have to pay for your property taxes. You have to pay for your insurance. You have to pay for your maintenance on the property, because sometimes the toilet's gonna break. Sometimes the roof's gonna get old. You have to pay for the management fees, because I don't want you to be the person that has to fix the broken toilet. I don't want you to be the person to get the call when the roof is leaking. There are property managers that can do that for you for a percentage of the rental income, and you want to factor that in there as well, because even if you're managing the property yourself, you should pay yourself. So always factor in a management fee, and I never manage any of my own properties because I got a business to run, I got other things to do. And then you want to factor in a vacancy cost as well, because the reality is tenants move out. And when you have the tenant move out, there's going to be time before a new tenant moves in. So you're going to subtract all these expenses, and you want to have money left over. Now, there's a few ways to buy the property. You can buy this property all cash if you have $200,000 in your bank account. You can buy this property with a mortgage, meaning you're going to put down 20, 25, 30% and then finance the rest. Or number three, you are going to go out and pool money together from a group of investors, and you're going to all share equity in the property, which means essentially you're buying the property all cash. You're just getting the cash from investors as opposed to a bank. But here's where you have to know your numbers. This is what is going to give you what's called your NOI, net operating income. And you need to know the numbers. If you bought this property all cash, what type of returns would you be getting? So let's assume that hypothetically, after paying all of your expenses, you are making $10,000 a year in profit, because you're renting it out for $2,000 a month. You have $24,000 a year of potential rental income, minus all of your expenses, you're left with $10,000. Is that a good return or a bad return? And the way that you do this now is you take this $10,000 number and you divide it by your cost of acquisition. Your $200,000 that you put down. So you do the math, $10,000 divided by $200,000, that equals a 5% return, a 5% distribution, a 5% cap rate, a 5% cash on cash return. A lot of terms for the exact same thing. But what this is telling you is if you bought this property all cash, you're gonna get a 5% distribution in cash in your pocket every year. Is that good? Is that bad? And this is going to be up to you. For me, This is not good. I like to see a 7% cash on cash return to make it worthwhile for me. So if I'm investing $200,000, I want this to be $14,000 a year. Now you might say, well, Jaspreet, that's really hard to find. Yes, it is in today's market, but it's not impossible. Because even in 2021, I like to tell this story because, well, 2021 was one of the craziest housing markets of all time. It was one of the hottest housing markets of all time, where every single property was being sold way over asking price. It was impossible to find a deal. But even in 2021, I was able to find deals. Did it take more work? Yes. Did it take more time? Yes. Did I have to walk through more deals? Yes. But I could still find deals in 2021. This is where I want you to understand real estate is a good industry for people that are willing to put in the work. There's a funny saying in business, so I'm gonna say this again in this video. How hard could it possibly be? That single line has humbled more people than anything else in business. It is hard, but if you're willing to put in the work, you can see amazing returns if you're willing to go through that hurdle. Now, this is where things really start to get fun, because let's assume you do have $10,000 a year in income. You generally would have to tell the IRS, hey, I made $10,000, so I have to pay taxes on $10,000, but with real estate, it's a little bit different, because with real estate, you get to first file what's called a depreciation deduction, which means you get to tell the IRS, hey, my property is 1 year older, and because it's 1 year older, I deserve a tax break on my property. So in this example, I bought the property for $200,000. Let's assume $30,000 was the value of the land, $170,000 was the value of the property. That would mean that I would be getting more than a $6,000 write-off every year just because my property is 1 year older. This is doing the most basic depreciation offered by the IRS. Then you can go on and take even more tax breaks, kind of like ordinary or necessary. For example, if I need a cell phone to run my real estate investing business, well, I could take some of that as a write-off because I need a cell phone. It is ordinary and necessary in order for me to run my business to lower some of my tax liability, which means, yes, I can make money kind of passively. It's not fully passive, but kind of passively, and pay less money in taxes legally. But this is where you want to get a good accountant to help you out with that. Asset number 4, getting even more advanced, is a business. I'll just give you a personal story. Many people know me because of my YouTube videos on minority mindset, but the reality is minority mindset is not my full-time job. This is my hobby. My full-time job is I am the CEO of a company called Briefs Media, BM. But not only am I an employee at Briefs Media, I'm also the owner at Briefs Media. And this is where things get very interesting, because there's a difference between being an employee at a company and being the owner in a company. So let's give some hypothetical numbers. Let's assume Briefs Media makes $1 million in a year from all of our operations. Then we have, let's call it $600,000 a year in expenses. That's our salaries, our software, our rent, and everything in between. That means we have $400,000 a year in profit. Who does that profit go to? Well, this profit goes to the owners of the company. In this case, it's me. Now, Briefs Media is a little bit unique because we also have a profit share system in our company where some of our profits are distributed with the employees as well, because I am the only owner. However, generally, the way it works is profits go to the owners only. And this is where things get fun. There's 2 ways to go out doing this. Number 1 is you can go out and start your own company, which is very difficult and a lot of fun for the right person. Some people are gonna hate the idea. In fact, most people will probably hate that idea, but some people will love it, which is fine. But the alternative for, again, some people is you might be interested in going out and buying a business. There's a lot of businesses out there that you can purchase where now you get your share of the profits. Again, there's a difference between working in the company. As a CEO, I get a salary, that's right here, but there's a difference between that salary and the profits. Profits go to the owners. Owners don't always have to work in the company. But to make this work, there's a couple things you want to know. Number 1, in many businesses, especially smaller businesses, you are gonna have to work in the company in order for the business to work. That's not a very attractive offer if you want to be passive. If you really want to be truly a passive buyer, you're going to need more money. We're talking about hundreds of thousands of dollars and sometimes millions of dollars just to get started, so you're aware. If it's smaller than that, you're probably going to have to work in the business in order to grow the business so you can eventually fire yourself as the CEO or whatever position you are in the company. Number 2, you want to find an industry that you can either work in and succeed in or want to work in and succeed in. Building a business is hard. I talked about this just a couple of minutes ago, but there's a saying in the business world which goes, how hard could it possibly be? That line has humbled more people in business than anything else because business is hard. And if you are getting caught up in the excitement on the internet of people saying, just go and buy a car wash, buy a laundromat, buy this, buy that, well, it's pretty hard to make money in any business and keep sustaining that profit and growing the profit if you're not willing to put in the work. So if this is something that you're thinking about, great. There's a ton of potential. You can make a ton of money. You can see a ton of success and a lot of fulfillment doing it, but you gotta be willing to put in the work. If you're not gonna put in the work, you are not going to see the return and that business will die. And asset number 5, which is technically not the most advanced, I just kept it number 5 because this is not something that I've ever done before, is peer-to-peer lending. And what this means is instead of you lending your money to, say, the United States government, you're gonna lend your money to somebody else who maybe wants to go out and buy a rental property. Maybe they wanna buy a car. They need some sort of personal loan. You can go out and lend your money to that person. Now, this is difficult if you do this by yourself, but there's a lot of services on the internet right now. I'm not sponsored by any of these companies, but you can go online and find a bunch of peer-to-peer lending companies that can help you find different ways to lend your money to people. It's called private credit. And the way it works now is you're gonna lend your money to somebody who needs it. Now, ideally, my personal suggestion, as somebody who's never done this before, is I would wanna lend money to somebody where it's backed by some sort of collateral. Ideally some sort of real estate, because if they default and go bankrupt, you want to have some way to at least get some of your money back because there's a chance that they will not pay you back. I mean, that's the risk as an investor. Now, the nice thing about this private credit market is sometimes the interest rates can be pretty high. I mean, 5%, 10%, 15%, I've even seen 20%. But you guys also remember, if somebody's paying you 10% in interest, they got to be making more than that. Now, is it possible? Absolutely. You see it all the time in real estate, where real estate flippers are going to pay more than 10% in interest to borrow their money because that's just how the real estate hard money lending game works. But if you want to get involved in that business, that's a potential for you to create another income stream. But just like anything else, it's not easy. You got to be willing to put in your work. I don't have personal experience here, so I can't tell you how to do it, but I've heard of people doing it, and it's something that you can consider as another way to create income from the money that you already have. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.